Hi everyone, David Guy here, Winning Stock Trading. It's Sunday morning, August 16th, 2015. I'm losing track of days because I've been working too much. But in any event, the purpose of this video is really to give you a quick overview of where the market is, at least on the major indexes and the dollar, the US dollar, and interest rates. And bottom line is just give you a taste of what it is we do so that you have the information you need to, at least understand a little bit about what's going on in the market. You aren't going to get this information in a newspaper. You're not going to get it in a magazine. You're not going to get it by watching TV. This is exclusive information. And I get my information from one source and one source only, and that's from the stock charts themselves. Anything else that we hear through the media is irrelevant. If you believe in technical analysis, which I know for a fact works, and I know that some people on Wall Street use it in addition to fundamental and quantitative analysis, but there's a lot of people who are skeptical, but that's just because apparently they haven't done their research, or they just can't watch a video and say, you know what, yeah, these coincidences don't happen that happen all the time are not just coincidences. So we can't predict where the market's going to go. I can't predict where it's going to go on Monday or this week or next week or even next month. But what I can do is analyze the components that make up the performance of the overall U.S. stock market and the various major indexes, and give everyone an idea of what is most likely based on the current the current status on each index, or to say it a little bit barely, we look at the weight of the evidence, so we take a look at all the various factors, and bottom line is we make a forecast, up, down, neutral. It's as simple as that. So let's get into this. The first chart you're looking at here is a NASDAQ composite. You can see it right up here. That's the symbol dollar, COMPQ. We're looking at the 9-month time frame. We're looking at weekly candlesticks. These are called candlesticks. And I'm not going to get into great detail on those, but you'll see in other videos exactly what we, how they work and what we use them for. So let's get started. So you can see that, as of December last year, that's just because I'm over here. If I go here, then you can see up here, you'll see up here, bottom line is what date it is, and it's all based on where I'm at in terms of which weekly candle I'm at. Okay, so you'll see the date, you'll see the opening price, you'll see the high for the day, the low for the day, and you'll see the price that it closed at. You'll also see the range. So on the composite, the range is 126 points on a weekly basis, is what that tells us, since we're on the weekly candle. So in any event, you'll see markings on some of my charts. Some others you won't see as many, but by watching this video, you're going to have a good idea of kind of where we think things are. To actually learn more would require that you become a paid member of the site. So I'm not asking anyone to do that today. I'm not asking for anyone to take my word for what I say. I just ask people and highly encourage them to do one thing, and that's real simple. One is to, I should say more than one thing. There's a couple. One, first, keep an open mind, and secondly, look at this information. Do your due diligence, and then you make your own decision. So, people who decide to take advantage of our service and various other services that are coming, should do very well as a result. With that said, there's going to be a lot of people who are skeptical. They're not going to do anything, and that's fine. If you want to just, leave your own assets there and subject them to market corrections and market crashes, that's fine. If you're not open to new ways of making money, and I have several of them, one which involves the actual trading itself, and one which revolves around the company and the promotion of our videos and services. So we have a number of opportunities. You'll want to watch those videos. Okay, but now, since I'm getting off track a little bit, let's get back on track because I want to cut this short. First of all, we have the composite index. That's the NASDAQ market. These are the biggest stocks, 2,000 or so stocks on the NASDAQ composite. I think it's 2,000. I could be mistaken, but anyways, I'll have to do my research to verify. But bottom line is this shows us the chart for the last 9 months. 9 months ago, this is where we were, and this is where we are today. So as we can see, we have an uptrend in the market, okay, for week ending August 14, 2015. Is there a trade set up on this chart right now? Yeah, absolutely. How long has the market pulled back? Well, 4 weeks from this high right there, counting that week. What's the short-term trend? What do I mean by short-term trend? Well, short-term trend means 1 month or less. So the short-term trend here is down. We can see that we've gone down for the last 4 weeks. The intermediate term trend, meaning 6 months, is up. Okay, if we looked at the 6-month chart, that's what we'd see. And then the long-term trend right here is up. And by long-term I mean 9 months or more. Back to the intermediate term trend, that means between 1 month and 9 months, at least in our, the way we kind of view things. So anyways, that's what this particular index looks like. Is there an opportunity to put on a trade in a paper money account? Yeah, absolutely. So that information is provided to members, and should you become one, you'll get that information both weekly, and also if there's a daily setup, you'll get that as well. All right, let's go to the next major index, the Dow. The media always talks about the Dow, but quite frankly, I don't really focus on those. The Dow is only 30 stocks. That's it. And those 30 stocks are included in the S&P 500 index. So, there's really no reason to consider the Dow 30 in terms of, well, that represents the entire market. The SPX represents the overall U.S. stock market, and so that's what most professionals focus on. With that said, we can look at the Dow index, and we do look at it because it gives us a clue as to what the 30 largest companies in the S&P 500 are doing, and gives us an idea of what their direction is, and and we really view these stocks as kind of leaderships, if you will. These are the generals. If you have an army, you have a general. You have other people, sergeants, and so forth. So the Dow Jones Industrial Average is the general, so we do look at it because that's a good barometer for us in terms of what we can expect, not only nationally but also internationally or globally as well. So that's that index. You can see the details right here. August 15, trade set up, yes. Another trade set up, 13 weeks. I have one too many S's on there. Let's fix that right now. And well, I'll tell you what, I'll get back to that later. We have 2 S's. Short-term, intermediate term, and long-term trend all down. Our forecast down. We don't see any reason why it should go up, except though in the meantime it might go up. It might bounce from here and go up, but we don't. But the long-term forecast on this, based on what we see on this chart, is down, which isn't good for the overall market. All right, let's move on to the NASDAQ 100. This index is similar to the NASDAQ Composite Index. In the NASDAQ 100, these are the 100 largest companies listed on NASDAQ. So these are kind of, I guess, the generals, if you will, of this particular index. And what this shows us that there is a trade set up right now, that the pullback duration right now is 4 weeks again, starting right there, counting all 4 of these candles. The short-term trend is down, the 4-week time frame, or 30-day time frame, or 20 days actually, because we base it on trading days. The intermediate term trend and long-term trend still strong. They're up. Okay, and our forecast right now, based for the short term anyway, is up. Based on what the chart is telling us. All right, let's move on to the small caps. Small caps are, the smallest companies out there. They typically have, I believe it's 3 to 5 billion in terms of market capitalization. Market capitalization is simply the dollar amount when you take the number of outstanding shares times the current share price. So these are the smallest companies. These give us a real good clue as to what we can expect for our own economy, and it gives us a really good clue in terms of where the market overall might be headed. So this is where we're at on this right now. We do have a trade set up. We're pulled back now for 8 weeks, starting with this high. We're down on the short-term and intermediate-term trend, but on the long-term trend, we're still up, which is a positive. But, if that turns down, obviously that's not going to be good. So our forecast on this right now, at least for the very short term, like 30 days, it's that we may go higher, based on what this chart is showing us. But so far we don't, necessarily have, it could just, bounce a little higher than this week's high, or last week's high, I mean. But at the same time, it could go lower, and it could end up here where we tested these lows before, back at the end of 2014. So this is a bullish candle in my estimation, though. So that tells me that the market could be ready for a bounce. The question is, how high? So that's that. That tells us a lot. And the reason why the small caps tell us a lot is they're the smallest. These are the stocks that are typically, the smallest in terms of market capitalization. They always are the smallest. They don't have the market cap of a Facebook or an Apple, or a Google or a Priceline or any of these other really huge companies. So, so that's worth noting. And the other main aspect of the Russell 2000s is they give us a good barometer of our own economy, because most of their products are, are available in the U.S., the U.S. only. They typically they don't have diversified markets. They're not doing a lot of business outside the country. And typically, they don't have much of a diverse product line. So, they don't have a lot of, when the market's going to go down, they're going to take the brunt of it, and they're going to show up first as going down in all probability. At least in my estimation. All right, let's go on to semiconductors. Semiconductors are a major component of the technology sector of the market, and we can see here that this pulled back now for 11 weeks, starting up here. All the short-term, intermediate-term, long-term trends down. Our forecast down. Trade set up, yeah, there is. And you can see here that we might bounce from here. This is kind of an area of support from back at the end of last year, but we could very easily just continue the move to the downside. So time will tell. All right, now let's get on to the main index, the S&P 500. We can see here that the S&P 500 on the 9-month time frame is up slightly. And when I say up slightly, I just measure from the close of this particular candlestick to the close this week, and we can see that's an uptrend to some extent. Not a huge one, but it is up still. Let's get rid of that line. We can see that both the short-term and intermediate term are down. I guess we could say that the intermediate term of 6 months, well, it is down, because if we even go back 6 months, you can measure from the close on this particular candle to this one, and that's going to be a line that's slightly down. So, both short-term, meaning 4 weeks, that type of time frame, and the intermediate term trend are down. Our forecast on this is sideways. I mean, there's no really other thing we can say at this point. We see that it's hitting these various highs, and it's hitting these various lows over the next, over the past, let's say since February, past 6 months or so. So we're in a sideways trading range. Once the market goes up a lot, like it has, since March 2009, typically it will consolidate those gains, and a lot of people will take profits. Others might be short-term traders, but at this point, it's a matter of, how long does this stay like this? The longer it stays sideways, the more likelihood there is that we'll pull back and we'll correct and we'll fall below the 2039 level and then test these levels here down at the, this one's at the 1972 area, and this one's at the 1980s. So looks like we could have a test of the 19 area, which means there's a lot of money to be made in the short term if this breaks. So far, it's not showing that it will, but if there's a geopolitical event that no one expects, or if there's a natural disaster like the tsunami in Japan a few years ago, or if there's a major terrorist attack, or if other countries in Europe default on their debt, there's just so many different things that are at play here. When the Fed raises rates, that's not good for stocks typically, because it's more expensive for companies to borrow. And so, my thinking is this. The trend is up. It should go up. It should break out of these highs, and we should be up here somewhere and start setting new highs. But at the same time, if I had to make a bet, and I don't bet, I use educated information, but if I had to make a bet based on the information I've got, I would say I think we're probably going to come down here and at least test these lows. And who knows from there, time will tell. But the fact is, if you watch my videos on market history, you'll see that you know, what the trajectory has been since our low in March of 2009, and you'll see how we've gone up almost in a straight line. And you know, that just doesn't, you know, happen forever. It's going to end at some point. We're in a long-term bull market since March 2009. There's no doubt about that. We're up for you know, 2009 to now, so that's 6 months and about you know, 6 years and about 4 months. And so we have to expect it will continue. But again, as you know, the longer it takes, or the longer it stays up here and is not able to break to the upside, you know, gives us more indication that it'll break to the downside. So the good news about that is I like the market to go up. I want you know, obviously a great economy here and abroad like everyone else, you know, but you know, the reality is, if that doesn't happen, and when the market does correct, there's a ton of money to be made when the market starts coming down. A lot of retail investors just don't understand that, but that's a fact. That's a reality. There are products out there that take advantage of that. And when volatility goes up, there's strategies that can be used to take advantage of, you know, the higher volatility and the, you know, the breaking of this type of a support area. And so there's just so many things out there people just don't know about, not because, you know, just because they haven't received the information. You know, people on Wall Street are not going to tell you what you should do. They're all about making money for themselves. So we all know that. I mean, if you doubt that, you know that the vast majority think like that, then you know you're probably mistaken. You know, now that's not to say that those on Wall Street, that everyone on Wall Street has, you know, intentions of, you know, trying to take our money. But the reality is, on an overall basis, you know, we're misled by Wall Street, and we need to understand that. So that's what we're about. We're all about educating consumers. All right, now let's go on to interest rates. Okay, this is our 10-year note, TNX CBOE 10-year interest rate note. CBO stands for Chicago Board's Options Exchange, and this shows right now that we've pulled back for nine weeks, starting from this high right there. The trend on the short term is down, meaning 3 months, or meaning 1 month or less. Intermediate term, 6 months or so up, and then long-term trend is down. So that says quite a bit. But at the same time, you know, we've been stuck in these low areas, and you know, it wouldn't be surprising to see a pickup on these rates when the Fed, you know, interest rates will go up when the Fed decides to start raising rates, because that's going to affect the stock market. And you know, typically raising of interest rates, you know, helps you know, equity, or actually hurts equity prices, and a rise in interest rate also decreases the value of bonds that you may own. So if you do own bonds, that's another thing you should be thinking about. So anyways, now moving on, we'll talk about transportation. This is the Dow Jones Transportation, and we can see we're up on the short term, intermediate term, and long term down. Our forecast is up, and there is a trade setup. So you know, this is kind of important too, because we can see by transportation, you know, quite a bit about you know, where, you know, the market overall might be headed. So that's that. Then we have the NASDAQ Transportation. You can read all this if you like. I've got to cut this short. Then we have the VIX. That measures volatility on the S&P 500 stock market. You can read all of this. Everything is down, short term, intermediate term, and long term. And the fact is, that's good, you know, for equity prices. That tells us that there's not a lot of fear in the market right now. That's what this index tells us. Our forecast, neutral to up. You know, could it go lower? Yes, but we're at really low levels right now in volatility. So in the intermediate to long term, you know, I expect this to jump up, and you know, into probably the 19 area, and most likely the, you know, 20 to 25 area up here. That would not be surprising at all. And then when we do have a crash, we can expect it to go up even higher. So that's that. One last thing to cover: the U.S. Or the euro relationship with US dollar. Let me move this. All right, this shows us that we're up on the short-term trend. That means, you know, for these 4 weeks right here, we're up slightly. Okay, because we closed here. We're actually we could say neutral, because if you look at the close on this candle, no, we're up still. The close on this candle is right at the top where my mouse is, or pointer, and then the close of this candle is here. So we are up a little bit. So in any event, you know, the dollar typically, when it's strong, it's not good for commodity prices or and the stock market. But what's happened in relation to the stock market is, even though the dollar has been so strong now for, you know, past year plus, you know, even though that's the case, stocks have been going up. So, but usually they have an inverse, you know, relationship. So when the dollar value goes down, stock prices typically go up, and that's how it works with other commodities as well. So that's it. I went a little bit over here, but I want to make sure everyone has a good understanding of, you know, how we look at the market and, you know, kind of what we expect for the future. So have a great day. God bless. And, you know, if you like our information, please watch the previous video. You know, which talks about the release of our website and the new launch, and so that you can, you know, like us on Facebook, plus us on Google Plus, and connect with us on various social media platforms. You know, if you find the information useful, you know, we highly encourage you to share it with others. Should you do that and decide to send out just a brief video link, you'll be able to do that, and then you'll be able to make income based on everyone who subscribes as a result of your efforts. And we're talking about some serious income with very little effort except for sharing the message. That's it. So in any event, have a great day again, and we'll be on to other videos today, and hopefully it give you some stuff that you haven't learned before. Okay? Bye now.